Hello, it's Tristan here from Zebra Invest, and today I'm running through how you can easily analyse property investment deals and quickly work out, is it a good deal? So whether you're looking for buy, refurbish, refinance opportunities, or you're looking for flips, this works for both. And that is whether it's a buy-to-let, an HMO, any kind of deal, the same principles apply. And the whole idea is to make it really easy that when you're going through and you're looking at opportunities, what deals out there, what works, and we'll go straight off the bat there. So I'm going to keep this really simple, break it into two parts. First of all, we're going to do the buy, refurbish, refinance, and then we're going to do flips later on. So what we're going to do here is just jump onto my computer and show you a calculator. So if you are opening up your calculator and having a look, the whole idea here is you're going to be looking at the end value of property. This works for both flips and buy, refurbish, refinance. So if you don't know how to do that quite yet, I've done videos how you can value properties using Rightmove and Zoopla, or if you want to automate it and make your life a little easier, jump into using property data or property filter. So what we're going to do here is you take the end value of a property. So let's say that is going to be £250,000. The first thing we want to do is deduct off effectively what's going to be our profit or what is going to be our deposit at the end of the property. So what I do here is £250,000 times by 0.75. And the reason it's 0.75 is that is 75%. So here you go, you can see £187,500 is 75% of that. So the next bit we do is we times that by 0.9. And the reason here is that's going to take off 10% for costs. And those 10% could be your legal costs for buying the property. It could be the stamp duty to get into it. It could be your finance costs. But the idea is we're working this out from the top value rather than the lower value to try and include that all roughly within that figure. So now that leaves us with £168,750. And at this point, this is how much money, if you weren't doing a refurbishment and you were just trying to buy it cheap and below market value, how much you would need to buy it for so there's no money left in the deal. But the next thing you've obviously got, if you bought a property for £250,000 and it needs a refurb or needs work doing to it, you're going to need to take off those costs for the project. So say in this case, we're going to spend £30,000 refurbishing the project. This means we can afford to pay £138,750 to buy this deal. So, and that would leave you as the absolute golden goose, the deal that's going to owe you no money and you can get it completely refinanced out and you'll be able to demonstrate that you've got a great deal there. And that is the perfect buy, refurbish, refinance deal. But it's not always going to be the perfect buy, refurbish, refinance deal, and you're not always going to get the unicorn where you can pull your money out. So the next bit I tend to do is then work out what I'm comfortable having cash left in the deal. So say, for example, you were happy to have £10,000 left in the deal, 20,000 or 30,000, you simply add that number back in. And usually what I try to do is think about what kind of return on investment I want, to then think about how much cash I'm having comfortable left in the deal. So simply, you would then click here and you would add in, say, £20,000 if you're happy having £20,000 left in the deal. So there, in this case, you can then pay £158,000 for that property, knowing that at the end of the day, you've made a really decent property that you can hold on for a long time and it only owes you £20,000. But now, I said I'll also explain how you do flips. So flips are just as simple. So the idea is, say for example, this property here was £250,000. Instead, usually a lender, like a bridging lender, are going to ask to see that you're making at least 20% profit margin on it. So what you do instead, you times it by 0.8, and that brings it down to £250,000. So the profit there is £50,000 for you. The next thing is you times that by 0.9, and that is deducting the 10% off for finance costs, your legal costs, the stamp duty to getting in and buying that property, and that's going to help you then get that point. So at this point, you're going to make a decent amount of money, but you still need to do the property up. So earlier I said we'd probably be able to do the same property up for £30,000. So here we're going to take the £30,000 off. And the reason being here is a little bit different calculation, because this time around we've got £150,000 is the number that we're willing to pay for this property, where we can make a 20% profit margin at the end of it. So you know, if you buy it for £150,000, spend 30 on it, plus all your costs, you're going to be in for making, as I said at the beginning, a 20% profit margin, which is going to be £50,000 profit on this property. But that's before you get the tax man come along and sting you for it. Usually, I used to say that I use 92% of the number that I'd multiply it down to bring down the cost, but stamp duty has increased and so has interest costs. So I really hope this video has helped you being able to analyse property deals really quickly and just have a quick look through, and you can get an idea of how to value a property and work stuff out without going off and viewing tons of properties and spending a lot of time in it. Hope if you've got any questions about this, please drop them in the below. Hopefully I can answer them. If you like this video, please like this video and subscribe to my channel. Have a great day, and thanks for your time. Cheers.